ladies and gentlemen, and a very warm welcome to each and every one of you, both here and joining us online via LinkedIn. It is absolutely fantastic to have you here at the launch of the Where to Invest in Africa report for 2025-2026. My name is Nastasia Arendse, and I'm delighted to be your host for what promises to be an insightful and thought-provoking session. So this year's report provides us a fresh, in-depth perspective of the evolving landscape, especially the investment landscape on the continent. And what a story it tells. Covering 31 key markets comprising of a massive 90% of the continent's GDP. This report unpacks the macro trends, the market movements, as well as the policy shifts that have influenced investor behavior right across the continent. And of course, 2025 comes with its own unique outcomes. We did have election outcomes, trade policy shifts, as well as currency devaluations, as well as debt restructurings, each of which have played a role in shaping investor confidence right across the continent, as well as investment flows. And this report reconnects us with the themes that you would have seen from the previous years, and it gives us a great sense of the evolving investment landscape. And of course, we do have a lineup of fantastic speakers who are going to be guiding us through it all. But before we dive into all of that great content, I'm going to take a moment to go through some of the key formalities to make sure that you and I get to have a smooth experience throughout this particular session. So for those of you who may need the restrooms are located right behind us. If you came in and you did not collect a parking ticket, at the end of the session, you can, of course, go to the registration desk to pick up one. And as a courtesy to our fellow speakers, as well as the attendees, do make sure that your phone is on silent throughout the session. You can join the conversation online. I do know many people are joining us via LinkedIn, and of course, we do want to see some of your thoughts on the insights that are shared here on the stage. So you can post, share, and like using and connecting through all our RMB official media channels. Be sure to tag us in the hashtags to use our hashtag Where to Invest in Africa, hashtag Think Africa, and hashtag investment, so we can also follow along and get to see what is inspiring you throughout all of these conversations. After the panel discussion, which we are going to be having a little bit later on, we're going to open up the floor for Q&A discussion. So for those of you who are in the room, we will have microphones for you. And for those of you who are watching online, we will be monitoring that chat facility so that any of the questions that you do have, we will make sure that we try to answer them. But as we get things started, for me, ladies and gentlemen, it is a pleasure to welcome someone who needs no introduction. He has extensive experience in analyzing and translating macroeconomic and financial market insights into asset allocation, investment decisions, as well as mitigating risks. He has more than a decade of industry experience spanning both public and the private sector. Please join me in welcoming to the stage Isaiah Mhlanga, who is the chief economist at RMB, to deliver the official opening remarks.
Good morning, esteemed clients, colleagues here in the room, but also good morning to the audience online on LinkedIn. 2024 was a big election year. It has ushered in change in policies, not just in Africa, but in all the economic powerhouses of the world. What we are living with today and what we're going to see over the next couple of years is going to transform how capital flows, how economies grow, and how most of the economic and social issues that we have get solved. But it's so difficult to analyze the changing dynamics and their implications without the use of data, which is what we believe the Way to Invest in Africa brings to the table. It gives us a no emotions analysis and look through to how countries are performing to help either policymakers or investors or businesses that are looking to take advantage of the growing continent that we call home. From last year's elections, there are key themes that are going to be discussed today. You would know several countries have cut aid to much of the African continent. So there is a from aid to exports and investment theme, but we also have a lot of other dynamics that are in the report which will benefit by digging through after the discussions today. But overall, as I welcome all of us and leave the stage for the next session of our esteemed speakers and guests, please dig through into the report, engage with the report, invite our teams to come and explain and figure out where are some of the opportunities for your own businesses, but also where are some of the risks that you need to be able to mitigate with. We do have a lot of colleagues that are sitting in the room today that can also give you a different insight as you try to find solutions for your own businesses. This year's 2025-2026 Where to Invest in Africa is quite unique in the sense that it gives beyond the rankings of the investment attractiveness an export potential model, but also a currency model that you can use to look for opportunities, but also to mitigate the risks of currency devaluations or currency movements. So it is in that respect that it holds a special space, particularly this year, given the volatility that we're seeing, the uncertainty that we're seeing across most of the key economies on the continent. Please join us in looking through the report, in looking at the countries that you invest in also helping to grow the continent by investing in this region that we call home. Thank you so much, and I hope you are going to enjoy today and you are going to take with into your businesses and beyond. Thank you so much.
Thank you so much to Azaya Mhlanga. Well, to get us underway and unpack the key themes, ladies and gentlemen, please join me in welcoming to the stage Professor Adrian Sebel, who is a professor of economics and finance at Gibbs.
Morning, everyone. I love that Isaiah intros this by saying that this is an emotionless. I tell you what, if you were part of the team building this, emotion was abundant. There is a vast volume of knowledge embedded in this report. And Isaiah makes a suggestion, reference to digging in, rolling up your sleeves and digging in. And I think that is an invitation into what is an encyclopedia. I'll get to talking about the construction of the Where to Invest toolkit in a moment. But just on the way there, perhaps to give some context, adjacent to my professorship at Gibbs, I look after an enterprise called Boundless World. And the team from Boundless World is not only here in the room with us this morning, but also online. And just a hat tip to them first for the incredible effort that has gone into this, that wouldn't be on the table were it not for this fantastic team. My jump-off point is to bring a perspective or a lens to where we find ourselves in the world. And the suggestion here is that we are upside down, inside out, and back to front. In the early part of this year, by wonderful coincidence, I reran into Lewis Carroll's 1871 book titled Through the Looking Glass, which tells the story of a young girl, Alice, who in her family living room is toying with her image of herself in the mirror, the looking glass, and discovers to her fascination that she can actually go through the looking glass. And as we know, when mirrors reverse everything, and when she goes through the looking glass, the world truly is upside down, back to front, and inside out. So in order to stand still, you have to run fast. logic takes on its own preferences, logic bends. Words take on any meaning the speaker chooses. I can't go too far without saying Trump. Words take on any meaning the speaker chooses, and time travels backwards. This is a lovely, lovely thought experiment. Time travels backwards, so you remember things before they happen. And as I'm flipping through this book, I'm thinking, this is not 1871. This is 2025. Quantum computing, artificial intelligence, big data, and look no further than election turbulence. And I use the word turbulence very deliberately here because turbulence is more nuanced, subtler. It lands up in a different result than turmoil. Turbulence, you get to land, but you perhaps land in a different arrangement or order. And this is exactly what 2024 and the early part of 2025 have delivered to us, is spectacular political change, as Isaiah suggests. All the way from Mexico, Claudia Sheinbaum, where a conservative Catholic society elects a Jewish woman as head of state, through to the most recent turbulence in Japan, where Takaichi Sainai has been appointed head of state. In a conservative, hierarchical, male-dominated society, Japan's LDP has elected a woman to run the country. And those are not the exceptions of the last 18 months. Those are the rules. So the big headline as we went into 2024, and we spoke about this at the launch of last year's Where to Invest in Africa report. The big headline was that 2024 was going to be the most democratic year ever. More people would go to the polls than any year in history. Absolutely, and as a percentage of world population. That was intriguing. What was absolutely fascinating was that in the majority of outcomes, there was a change of political power. And so we have a world that politically looks spectacularly different as we finish 2025 than the way it looked when we started 2024. And if I put on a marketing hat for a moment, the way we vote tends to be the way that we buy cars. We are habitual. We buy the same car badge as the one we bought last. And the way we tend to vote is the way we tend to vote last. So what this is, what I'm suggesting here is, as much as it's tempting to say, oh, people have changed their mind, that's not so much the story. Rather, it is the change of the demographic that is causing a different political outcome. And political periods run for 4 and 5 years. In other words, settle in. Here is a decade of change. What's even more remarkable behind this is the institutional integrity that held. And so the map that you see here gives a color coding and shows overwhelmingly the process was fair, peaceful, transparent. Institutional integrity held. But the fact, if I chuckle, it means a Trump slide is coming. The fact that institutional integrity held and that democracy brought different outcomes doesn't mean that change is easy and peaceful. And this speaks to the World Uncertainty Index, the first figure that we reference in the 25-26 RMB Where to Invest in Africa report. And it shows you that relative to recent periods, the uncertainty that we find ourselves wrestling with in this time is truly off the charts. So it's tried to sometimes suggest this is unprecedented. Well, if we compare the uncertainty in policy to COVID, global financial crisis, emerging market of 2015, this sits at an amplification of 2x, really off the charts. And how do we make sense of this? So now let me be serious and sincere about Isaiah's suggestion that this is an emotionless endeavor. The power of a framework is that it removes bias, judgment, fear, anxiety, short-termism, over-optimism. It removes all of these emotional and psychological dangers from helping us make a sober assessment of the investability of 31 markets in the continent. The structure and the weights that are attributed to each of the elements that make up the model are set out in detail in the report. And one of the important attributes of any type of index, whether it's an inflation index, an investability index, or an index of something else, is that it needs to be reproducible by others. So we lay bare the framework that sits in the underbelly of this construct. And what the lens that we're bringing here is the lens of an investor who is allocating capital. It is not necessarily capital from outside the country. Anyone allocating capital. What are the things that are going to attract them? And what are the things that are going to concern them? And what are the things that are going to derail them? All the way from policy stability through to currency instability sit resident in this model. So these are the dimensions sitting across 4 pillars, and I don't for one moment anticipate that you'll be able to get out the granularity, but this shows you the heat mapping, 31 countries across our 20 different components that make up those 4 pillars. Red is bad, green is good. And from that, we can quickly identify the big winners and those that have been set back by recent disruptions. Lots of attention given recently to winning the Powerball. You get the numbers for Powerball. There's a prize this morning. Guess the country that gets the biggest gains in the 2025-26 report. Even if you're online, you can shout out and put into chat. We'll go and find it later. From the room? Nothing? Anyone? Yo. I was at a charity event yesterday afternoon. Now I know how the stage guy felt. Okay, you are in the room. Our big lifter for 25-26 is Côte d'Ivoire, which has been serious about repositioning its industrial composition, moving up 8 places. This is a substantial gain. Again, the invitation when you dig into the report, you get all of the details. So this shows you how the country scores, and you can see across all 31 countries how they rank on each pillar, how each of the components contribute to the pillar, and then a waterfall chart which shows the contributions to the performance from our last report to now. So there's the open invitation. If we peer a little closer through our looking glass, we find that there are some other big movers up. Tanzania makes gains, Algeria makes gains, some less grand but still important improvement. Ethiopia, Kenya, Namibia have greens, and then some that have significant setback, perhaps a few that are worth pulling out. I should talk about the gainers. Zambia also makes their way in there. In terms of those that face big setback, perhaps the 2 to flag are Senegal and Nigeria. It's always tricky when you put a report together like this when the data is looking backwards, but events are happening in real time. So, for instance, how I wish we had written this report before South Africa came off the grey list. Friday afternoon. And, So the report is not silent on the grey list. We make reference to that in writing about South Africa, but there's no way we could have known that. And similarly, there's no way, we can start to build forecasts into a report about the impressive advances that Nigeria is making in industrial activity in real time. So we report what we see, and in the time that we're building this report, two really big things happen. The first is the Naira gets spectacularly devalued. There is a significant downward move, which means anything that you're putting into the report in dollar terms is halved. And at the same time, there's an announcement that the Nigerian economy has been rebased, and it is a grand rebase upwards. So this is the tricky animal that we are dealing with called data. Mark Twain says there are three levels of truth: lies, damned lies, and statistics. And so that's the animal that we are wrestling with. So again, the invitation is, in using this framework, please be mindful of the nuances and the subtleties. And we have been very deliberate in trying to write up where we bring fresh information, new information, how we deal with animated changes in the data. You'll see, for instance, particular commentary on all of these big movers. And then in closing, a couple of points just to highlight. And Isaiah made reference to this in his intro, that we have been deliberate in recognizing that aid might be off the table. We all stand in different places on the political spectrum on the merits of aid. We make comment on this in the report, but here is a moment for trade to displace aid. And that could be a very, very powerful contributor to the transition that we believe is underway in a continent that on balance is growing quickly. This shows you the aid potential, and importantly, what this trade potential report. That's a faux pas. So what this trade potential report highlights, amongst other things, is the opportunity that is really resident is not North America; it is elsewhere, and that is a wonderful aha in this moment. Second, we've tried to take you into the underbelly of the model by talking about growth archetypes, and we show countries that are doing impressive things by running current account surpluses whilst they are building strong internal balance sheets, investing in fixed infrastructure. So Zambia would be a superstar on that front, what we call homegrown builders, and then countries that are stuck in neutral, which are running current account deficits whilst they are underinvesting. Malawi would be the archetype there. Excuse me. And as a last note, we introduce into the 25-26 report the currency model. This is also always tricky because we print the currency model at the time of reporting, and currencies are moving tick by tick, second by second. Again, we've archetyped, so currencies that sit in undervalued territory with robust attributes we call coiled springs. And whilst this is a Pan-African report, we're writing from a South African room, or speaking from a South African room this morning, where overwhelmingly South Africans are cynical about the prospect of the rand. Well, here at the time that we produce the report, we talk about the rand as a coiled spring, and you have one of the best performing currencies in the world in your purse or wallet this morning, the South African rand. And not only is it undervalued, its structural attributes on balance are strong. And then you could go to the top left, places that have strong attributes but are overvalued: Swiss franc, US dollar, and places where you perhaps want to watch out that they are overvalued and fickle, what we call the mirage. Sudan would be the archetype there. And so here is another lens then in thinking about when you allocate your capital, in what currency and what will you get it back as? What form does it look like? Thank you for your time and attention, and I would welcome any comments, questions, thought as you get the opportunity to dig into the report. Thank you.
Join us on stage. Please have a seat. Pick anywhere, and please note that wherever you pick, whoever's closest to me gets all the hard questions. Okay, that's a safe spot. So this is the part where we take all the trends, the numbers, as well as the opportunities that you are going to be reading in this report, and we bring them to life in conversation. And this particular session is going to be talking about what's driving growth, where the opportunities are, but also where investors can position themselves, especially as they look ahead to Africa's next chapter. It was quite interesting as you were asking about which one was the biggest mover. I wanted to answer that because I'd read the report in preparation for this, but I figured he'd think this is a conflict of interest. You can't provide the answer as yet. But he's not going to be alone in giving us that conversation. Ladies and gentlemen, please welcome to the stage Samantha Sengjami, who is the RMB Research Lead. She'll be helping us look at the capital flows shifting and where investment is headed next, amongst other things. And then on stage, we're going to have Precious Dube, who is the RMB macroeconomist, unpacking the data, the dynamics behind some of the continent's most investable markets. Thank you. And as I mentioned, we are going to be having a Q&A session a little bit later on. So if there's any burning questions that you would like to ask in relation to what Adrian delivered, not just in his, covering off the key themes, but also in this conversation, you're more than welcome to do so. And then, of course, in the room, we will be taking questions as well. So let's get this conversation started. Let me come with you, Samantha, because going through this report, and people would have picked up this phrase as they read it. There's a phrase where you describe the year of elections as a historic super year. So one of the things that stood out to me is that as you think about that, how does this global political sort of instability that we saw, volatility might be the right word, how did that shape how you looked at this report going into it?
Yeah, thank you for that, Nastasia. I think there's two parts to it. So yes, there was the election cycle, and it was pretty heavy last year. Both Isaiah and Adrian mentioned some of the countries that went to elections, but obviously the impact would have been on the policy shifts that we see. And of course, the Trump's second term did cause a lot of uncertainty, as we've seen by the evidence in the index. But I think the way we looked at it, I mean, at the onset, when we looked at the model last year, or when we created it, it was always going to be a fact-based model, right? So, distinguishing the signal from the noise as such. And so that continued this year in terms of, our pillars. We had 4 pillars, the 20 indicators. So fundamentally, that didn't change. But I think the robustness of the model, especially the economic stability pillar, was something that catered for a lot of the political noise that we see. So that was the first part. But in the second part, I think, when we looked at the themes for this year, obviously the trade, moving from aid to trade was relevant, and then looking at investment flows. So just briefly, I mean, what we have seen, obviously, is there's a lot of export potential on the continent, and I don't think any country that we've labeled there has met its export potential. So we can talk about ways to get that, and the sort of trade partnerships, digitization, and those type of things. But that was the one theme. And then obviously the investment theme. So last year we saw massive inflows into the continent. Egypt was obviously a very large one, so the highest recipient of FDI. That was largely due to the Ras Al Hekma project, but it's still robust flows that are coming through. So the FDI and the investment was the second bit of that.
Yeah.
Yeah.
Adrian, let me come to you here. You touched on it a little bit in your opening remarks around dealing with data that may be lagging in some cases, especially as you produce this report. How do you deal with the trade-offs of methodological consistency as well as dealing with data that can be lagging as well? How do you balance that?
It's almost an impossible balancing act. Something has to essentially give, inverted commas, and what's demanded here is a common sense approach, because on the one hand, as Sam is pointing out, what you can't do is sort of fiddle with the model because you don't like something you see. So that framework is absolutely robust and uncompromised. However, if you put nonsense in, you're going to get nonsense out. And the case to go to in the case of the 25-26 report is, of course, Nigeria. I made reference to it, where in the space of weeks, you had two massive disruptions to the data. The first was you had the Naira moving spectacularly downward against the US dollar. So any input that's going on into the model in US dollar terms is going to be significantly debased. And then in the same breath, it was announced that Nigeria would be rebasing their economy and adjusting a lot of the numbers upward. And in a common sense says, we've got to give a recognition to that. So we've been very careful about writing up in the report in detail the way that we've treated that, because it is an exception. And having said all of that, with a second breath, when you're building a model based on economic data that's backward-looking and that is gathered in most instances through sampling, you know that there will be revisions to the data. So when we write a 27-28 report, it's going to require that some of the inputs that went into this model have been changed. That's a necessary evil of the construct. I think the two really important points to underline are the first, the absolute transparency where any data adjustments have been catered for, and the second is the robustness of the model, which means this can be rinsed and repeated.
Precious, let me come to you. The report notes that structural elements are slow moving, yet as we've seen on the screen, some countries had some really big moments. What surprised you the most?
The countries that surprised us the most were Cote d'Ivoire and Tanzania. Cote d'Ivoire is already highlighted by the Prof, was the biggest mover, moving from 16 last year to 8th in this year's edition. While we did expect movements, improvements in terms of Cote d'Ivoire and Tanzania because they have strong growth and broad macroeconomic stability, I think the 8-point jump in Cote d'Ivoire's case was a bit surprising. And now both countries make up the top 10, outpacing much larger countries within their respective regions. So for Cote d'Ivoire, it's now better ranked than Nigeria, and for Tanzania, it's now better ranked than Kenya in East Africa.
Sam, building on what Precious said, I mean, if you look at the previous editions, were there any assumptions that sort of threw you and the team off, especially in terms of expectations?
So I'm going to re-emphasize Nigeria because I think we had quite a few debates on that, and we wanted to obviously preserve the integrity of the model, so we didn't fiddle with that. But of course, a rebasing of GDP and a massive currency devaluation obviously affected its position. Again, Cote d'Ivoire plus 8 points. So I think, that shows sort of steady progress and reform. This is a country that's been through various IMF programs. It did just have elections yesterday, as Precious and I were discussing. But I think the reforms have been bold, and so that eventually pays off. And then the one that was a little bit odd was Botswana moving up a place, despite, there's been, I would say more recently, we've seen obviously diamond prices fall, and we know the diamond story for Botswana. And so I think that's probably going to be one to watch for the next round, just because fundamentals are not as great as they have been.
I'm glad, Adrian, that Sam brought up Botswana, because you did have the president of Botswana in one of your slides. And if we take what we've seen when it comes to the political shifts in Botswana, but then we also take in what we've seen with South Africa's coalition government. Typically, a lot of these political shifts, what have we seen or learned at least when it comes to how they influence investor confidence and capital flows? What have we learned so far?
You know, what Sam is saying earlier really underlines this. Is more than anything, when you're allocating capital, you're not thinking about the current political administration. Bricks and mortar, you know, whether greenfields or brownfields capital, is taking a decade view, a multi-decade view. And so you have to be looking beyond political. And so whilst we have an element in the model that speaks about political integrity and political maturity, what you're looking for beyond political is policy integrity and policy maturity. And so that's the key component that you want to give attention to, is what is the policy stability. The administrations will change. Now, in Botswana's case, as you point out, has been the same party for quite a long time, 58 years to be exact. So last year's change in party was truly remarkable, but policies stay intact. And so that institutional integrity of Botswana is a source of comfort for investors. Once you go behind that screen, then, once you're behind the curtain, now we want to start digging into industrial evolution. And here is where Côte d'Ivoire just leaps out in terms of improvements. Big strides in industrial evolution and development. And then where I finished in my presentation was talking about currency, because in the world of capital allocation, price is what you pay, value is what you get. And if you go into a country in what looks like an attractive currency, and then you find that either you can't get your money out, or you can only get it out at a substantially weaker rate, now you've got capital problems. And so there's a whole lot of nuances that investors are looking at beyond that immediate political question. So the political change we can take as a given. It's policy stability that we want to be placing emphasis on.
Let me stay with you for the next question. When we come to South Africa, there's a line that stands out here, and I'll read it to the audience, and you'll see it when you go through it. South Africa is stuck. Full stop. Now, based on your analysis, what are these bottlenecks that are proving stubborn, and what are we missing here in the conversation about how we reignite growth or get that momentum going?
We wrote that 4 words.
Yes, South Africa
it's a good
is
sentence.
stuck.
Let me get my team here. South Africa is stuck. And if you go to that archetype chart that I popped up, there's 2 metrics, or there's 2 things that we're measuring across the axes. The first is your current account. Are you running a deficit or a surplus? And the second is your investment business. Are you putting capital into the country, gross domestic fixed investment? And South Africa is in a challenged place on both. In order to achieve world average economic growth, you need to be investing at least at the same pace as the world average, 25% of GDP or higher. South Africa has been stuck in neutral, 15, 16, 17% of GDP for the last 15 years. The last time we saw elevated GDFI, gross domestic fixed investment, was commodity boom 2005, 6, 7. And it's that ingredient that is missing in terms of driving South Africa into elevated, faster than population growth. So as much as policymakers have been very animated talking about recovery and the restoration of confidence, and certainly there are some important positives happening, And here's why forecasting is an absolute nonsense. If I'd said to you start of last year, 500 days uninterrupted electricity, I would have been laughed out of the room. But here we sit with 500 days uninterrupted, so the energy network is back. Barbara Creasy is making important gains in the transport cluster. The grey listing announced, these are important gains that are happening. Now what we need to happen for us to get from neutral into first is that investment confidence to be restored. We can go to where to invest in Africa, and you'll see that South Africa is a highly investable country. And that means that we quickly get from first into second and third.
Okay, so we've spoken a little bit high level. I think let's sort of get into the details when we look at the different countries and the different movements. I want to go back to what we were saying about Nigeria. So if you look at the actual report, you'll see that Nigeria experienced the sharpest fall in rankings from 9th to 18th, and this was largely as a result of the currency devaluation as well as the data revisions. And Precious, I want to come to you for this question. As the team, and you look at all this data coming in, how do you separate the statistical effect from the economic effect when you assess such a case?
Yeah, so we do separate the statistical effect as well as the real economic effect. And you're right to say that there was a statistical effect, which was the devaluation of the currency that then saw the GDP in US dollar terms being much lower, although the country subsequently rebased and the GDP was then revised much larger, but still it was lower than what we had recorded in 2024. So that also got the country moving downwards in the rankings. Then the real economic effect that comes through in the narrative. So when you read the report, that comes through quite strongly that Nigeria, under the new president Tinubu, has been implementing very bold policy reforms. One was the collapsing of the multiple exchange rate, floating the naira, removing the subsidies, and also reworking the tax bill with the one big tax bill that we saw coming out. And when you read the report, you would get then the context that Nigeria is going through, or rather went through, short-term pains for long-term gains. Yeah. And now the country has been built up to be able to have strong resilience for broader macroeconomic stability over the longer term. So some of those reforms that they've done, for instance, so like the devaluing of the currency, it has led to non-oil exports picking up quite sharply. The cutting of the fuel subsidies is expected to improve public finances because it was really a huge waste in the country's budget over the years. So going forward, Nigeria would be able to withstand shocks much better with these bold reforms that have been put through. So we want investors and other stakeholders to read into this with this context, and the narratives comes through in the report.
Okay, we'll come back on President.
Could I offer just something?
Yes.
Sorry, you're the boss here, but to Precious's point, if these reforms are effective, look at the strides made in a quick space of time. Not to over-reference it, but Cote d'Ivoire shows you, Tanzania shows you, Zambia are good cases in point. And that's our suspicion. But remember, what this model isn't doing is this model isn't injecting emotion, and it's not forecasting. It's talking about the structures of a country. And so perhaps to make a second point, as Precious is responding, what's going on in my head is investors don't bring a single lens. They're not all looking for the same thing. Yeah. And so that's why we're at pains here also to talk about archetypes. And so bringing your particular investment lens. And then a third point, very briefly, is that you rank 27 or 28 doesn't make you uninvestable. Yeah. These are investable markets.
Okay, so let me stay with you for the next one. I mean, we've been talking about Nigeria's rebasing this, showing that the economy is 30% larger than previously thought. What does it then say about the role of informal and emerging sectors in the perception of African economies and how we view them?
So I think very valuable is that increasingly we've got access to alternative data, which helps us understand the drivers of economies. We know that everywhere data is underreported, and I've made reference to this. In the case of emerging markets, frontier economies, your unreported or underreported sector could make up 30-40% of the economy, quite comfortably. And so, depending on what you're going to sell, if you're selling refining equipment, then the informal economy probably isn't going to be of much interest to you. But if you're selling data, clothing, if you're providing digital services, then that underreported economy might be of real interest to you. And so, there you would need alternative data to help inform that decision. And that, again, is why we speak at length about the archetypes, recognizing that each investor brings a different perspective to their capital allocation challenge or approach.
Okay, so as we put a bow on the focus on Nigeria, Sam, let me come to you here, because I think Precious touched on it a little bit, saying that when it comes to President Tinubu's reform agenda, it's short-term pain for long-term gain. Is it really how we should be looking at some of these reform agendas, or does each one come with its own little nuances and risks and opportunities as you try to measure that short-term pain for long-term gain?
So I think that it's a bit of both, because you have to look at the idiosyncratic issues of the country, and we know that Nigeria is an oil economy, so if oil prices tank, there are more external buffers now because of some of the reforms, but it's still vulnerable. But I would agree that it is these short-term pains that we are seeing. But if I could just comment on real time, because we have been seeing a lot of flows coming into Nigeria just because of the FX reform that the country has gone through. So if you see, you look at their reserve build-up, it's quite high, around $40 billion right now. So that's in the case of Nigeria. I mean, apart from the fiscal reform, the currency reform, I think, with the likes of your Dangote as well, I think that changes the structure a little bit of the economy, the dynamics around the current account, and how that gets funded, or if there is a surplus in most cases, they can use that for better infrastructure development. So I do think investors are looking at Nigeria, despite having been pushed down on our ranking, they are looking at it from a perspective where they understand that these necessary reforms had to be done.
Okay, so let's move on to Cote d'Ivoire. Prof, I want to come back to you here, because when we look at the rankings for Cote d'Ivoire, we see it leap from 16th to 8th. It's one of the strongest performances, as you mentioned in your presentation there. What do we learn about the sort of export diversification in terms of the contribution it's had to resilience here when we look at Cote d'Ivoire?
There's a few things that stand out in terms of the gains that they've achieved. The first is, again, back to Sam's point, that in order for you to be able to leap, you need a stable structure and a platform. Otherwise, it's going to be more of a wobble than a leap. That you might gain on the roundabout, you'll lose on the swings. And so, sitting underneath are very important reforms, most obviously in their energy cluster, which then facilitates advances in manufacturing. I think that's the first big thing that stands out in terms of the country's gains. The second is that they achieved big improvements in export. Now, that is, lovely to get in any setting, and we could bring that to a couple of neighbors and all the way home. In real time, we could think about countries that are showing big improvements as we speak. Tanzania, Ghana, Mali, South Africa, these are the big gold producers. And they've done nothing, but they've got a gold bonanza going on. What will really matter, what will translate into structural advances, is if the raw gold turns into refined gold, if the refined gold starts turning into jewelry. And that's what's been going on in Côte d'Ivoire, is they've been iterating up the industrial spectrum, producing more sophisticated exports. And that's not an emotionally laden term. That's a sort of a reference to the complexity of the nature of the exports. So what's going on in Côte d'Ivoire is not only is the platform stronger, but the sophistication of exports is improving, evidencing industrial complexity. Now that looks increasingly investable.
Okay, so let's move on to a different country, Precious. Let's talk about Mozambique, which was also listed there. They've got these LNG projects that are expected to lift growth dramatically, at least in the medium term. How should investors contrast the short-term volatility with long-term potential?
So Mozambique is, I would term it a classic case of high risk, high rewards. Okay. So there are certainly high risks over the short term, characterized by elevated political tensions. We saw some of that post-elections late last year. Security risk in the north of the country, as well as a general sluggish macroeconomic trajectory. And this is really contrast against economic potential on the back of the LNG sector, which has the power to transform the country, driving up government revenues and changing the whole trajectory of the country. So investors should have this context as they move into Mozambique. It's not that it's an uninvestable country. It is. It's just going through short-term risks with an end goal of long-term potential. So what investors could do is that they could step into Mozambique armed with some risk mitigation tools to de-risk their investment with the goal of the long-end potential to be able to get those high rewards that I mentioned at the beginning.
Okay, I'm going to stay with you for a different country here. Another one that caught my attention was Zambia. So that one rises 5 places despite the fact that there was a severe drought as well as food insecurity. What signal do we take away here when it comes to whether we look at the country's structural strength and policy response?
So we can take away from Zambia in terms of structure. So the country is mostly dependent on copper, which saw the price increase over the last year, and Zambia did well to respond by increasing the supply of the commodity in that year. So that helped to offset the losses coming off the agriculture sector, which the country, you said rightfully, it went through the worst drought that it's seen in years. And also, we also saw, if we talk structure, some of the other service sectors, telecommunications and the like, also offsetting the losses in agriculture. And in terms of policy responses, the country is doing well to respond to reforms that they are currently implementing under their IMF program, and this really did well to help the country to withstand the impacts of the drought. And also, they've made quite significant progress in terms of their debt restructuring, which will see the debt steadily come down over the medium term.
Okay. Sam, let me come to you. Building on what she said there around the IMF and what we've seen around the debt restructuring, what role does credible debt restructuring supported by the IMF, and then of course you have an improvement in credit ratings, all of those 3 things, what role do they have in improving, let's say, investor confidence of other sovereigns like Zambia?
Yeah, I think it's pretty important to have sort of the IMF backing when undergoing some of these restructuring. And I think last year we had, or the year before, a lot going through this G20 common framework as well, just looking at restructuring and equality amongst the creditors. So I think having an IMF backing has been positive, just because there's that credibility element towards reform. So in the case of your Ghana and Zambia that have gone through restructuring exercises, both not 100% complete, but I think there's a lot more investor confidence that the IMF is there But on their own, I mean, there's also the idiosyncratic factors. You have Ghana that produces a massive amount of gold, and that helps. So, we will talk about commodity cycles and things in a bit. So that's helped Ghana in terms of confidence. But I think also Zambia, there's external factors to consider coming off a drought. But overall, I mean, the IMF backing, you get other multilaterals backing them, like the World Bank, the AFDB funding projects, and obviously you want your project pipeline to be a little bit more solid and less front-loaded than previously, because that's what causes some of the issues in the first place. So I'd say credible restructuring is very important. I mean, you don't want to be in the same place you are 2 years down the line, and investors obviously need to see that.
Okay, so we're going to move on to a different country now. Let's get to Senegal. Senegal, in the report, another one of these quotes that sort of jump out at me. It says here, Senegal's performance in the index for 2025-2026 is disappointing. And this is because you've seen this country fall 6 places in rankings despite the ambitious Vision 2050. Precious, I want to come to you here. So when you look at all of that, how do you reconcile short-term political disruption with long-term structural potential?
Senegal had short-term political disruption last year. So the former President Macky Sall initially wanted to extend his term to December 2024, and that caused a bit of uncertainty over that period and some disruptions, which in the end impacted growth for 2024. Although the growth still came off strong, it was lower than the initial projections because of that disruptions. Nevertheless, Senegal still went to elections in March 2024, where there was a change of guard. And with the change of guard, I think this, which is the theme of this report, a lot of things change. And the change of guard came in with a new broom, sweeping clean. And one of the first things that they did is that they reinvestigated the government public finances, and this is one of the things that underpin the lower rating, because the Court of Auditors in Senegal ultimately came out with a report that public finance data, specifically public debt and budget deficit numbers, were understated by the previous administration. So those have since been revised higher, and that revision higher debases the country in terms of our emotionless methodology that we use, so that saw the country then moving lower in terms of ranking. But we need to reconcile this with the potential of Senegal. So Senegal still does have potential, because in spite of everything that I've said, it's still got very strong growth, north of 7% in 2024, and the country's hydrocarbons sector, it's got huge potential and it's tracking very well. The exports are ramping up, so there is still potential, but that will, I guess, come into the numbers in future editions.
Okay, Adrian, we had Senegal's fiscal credibility questioned, and I think it was the IMF and the S&P that were quite concerned about the deficit underreporting. When we think about everything that's planned out here, or rather played out here, how crucial is fiscal transparency when it comes to determining a country's true investment potential?
This is part of a mosaic. When you're forming an investment view, you're trying to put together different pieces of the puzzle. And using that sort of mosaic analogy, fiscal credibility is an important component. And knowing that you've got reliable, robust, believable, transparent numbers, of course that helps. Not knowing what you're dealing with. And it's always easier to talk about other people's marriages rather than our own. Hey? And so just checking that is. And So look no further than the United States at the moment, where questions are now being raised over the credibility of numbers. So it's not just fiscal data, fiscal numbers that you're looking at. It's all data that you need to be able to place confidence in. So in a roundabout answer, that transparency and credibility is critical. When you jump out the cupboard and say, ta-da, the numbers aren't what they seem, and to go back to, Precious has spoken at length about Senegal, we could also go back to Mozambique, which a few years prior had a similar type of problem. And this eventually catches up, and it will spook investors. And anyone allocating capital is spoiled for choice. Capital is abundant, and we are spoiled for choice. So, a lens to think about, or a perspective to bring in this Where to Invest report is, here is the second fastest growing region in the world over the last 25 years. Only Southeast Asia grows quicker. Population is young and growing quickly, and you have we're spoiled for choice in terms of investability. So governments that are determined to attract capital should also be pointing this light or shining this light on themselves.
Speaking of, attracting capital, we get to what we call the growth archetypes, and people will see this in the report. And it's a nice visual that maps how countries balance openness when it comes to, i.e., current account with investment capital formation. What new insight are we giving off here, Sam, when we want people to look at those growth archetypes?
Yeah, I think the big takeaway is that not all investment is equal. So we have an archetype called the homegrown, and this is obviously where you have a current account surplus, and you can use that to invest in various infrastructure. So I think it's important that policymakers and investors sort of look towards getting their countries, or look at policies that they can apply to look towards getting their countries at that quadrant. What the report doesn't do, or what the archetypes don't do, is tell you at what pace you need to apply this. Some countries, and Zambia and Nigeria are in that quadrant. I would argue that Nigeria is doing some of the investment a bit slow. Zambia had been doing the investment a bit fast, which is why they were in a default. So I think it's a nice way to visualize where you want to get to. But then the policymaker would have to decide, the pace and the type of projects you would need to do to get there.
Adrian, there's another archetype within that says stuck in neutral. Mm-hmm. Historically, what differentiates economies that are stuck in neutral to homegrown builders? What typically happens as they move from one to the other?
Again, if we go to other places, there's a superb study done by Joe Studwell, who writes up in his work how Asia works. It does comparator economies and looks for the common ingredients of economies that transition and transform, and they have a couple of common features. And just so we can get in our heads, who are the countries that transition, transform in Asia. Historically, the impressive transformers include Japan, Taiwan, South Korea, that just stride ahead over multiple decades and lift from poverty to prosperity. The ingredients that they have in common are they are all investment-led. No country has got rich by consuming its way to prosperity. There's a big note to self on that. Every single country is investment-led. The second is they are export-oriented. In other words, they see the world as their market. And third, I think this card really is underplayed, is they transition through an agricultural supply chain. There could be big clues in that. And the fourth is they use repressive finance. Okay. If you want to finance infrastructure, If you want to finance refineries, warehouses, you can borrow 10%. If you want to finance a flat screen television, 20%. That's repressive finance. Those are the 4 ingredients. The stuck in neutral countries have missed all 4 of those notes. South Africa and Malawi are 2 sort of unfortunate cases in point. South Africa sometimes gets the message. But over the last 10, 15 years, South Africa has been stuck in this terrain, underinvesting, current account deficits, finance has fed consumption, and, enter at Gibbs, I look after the Centre for African Management and Markets, enter my rock star with his cowboy hat, Wandile Sishlobo, who is very animated about the potential of agriculture and the role it could play in the likes of South Africa, Malawi. That's what countries stuck in neutral need to get between their teeth.
On South Africa, you say South Africa sometimes gets the message. Is South Africa getting the message now? Is it touch and go?
Don't make me forecast. I've got to be back here in a year.
No,
right?
of course.
Let me be half full. Compared to 18 months ago, South Africa is in a materially happier and healthier place. I made reference to the energy, 500 days uninterrupted. Economic growth is not yet sitting up, but looks a fraction better. The strengthening rand will help. Commodity prices have stayed elevated. Of course, gold is the big story. South Africa is significantly smaller as a gold producer than 25, 30 years ago, but gold is still an important part of our export basket. So there's some things going on, if I use that mosaic analogy, and from our lips to I was going to say God's ears, but at least Barbara Creasy's ears, that the transport cluster gets fixed. You move those parts of the needle, and South Africa could start to talk about 2 and 3% economic growth quite soon.
Okay. So we've got about less than 6 minutes for this particular discussion, and I just want to remind all of you, if you have any questions on hand, I do hope you're noting them down, as well as those coming through online. If you have any questions that you want to ask, the panelists will be open in the next 6 minutes, well, less than 6 minutes. Precious, I want to come to you here because we've been talking about countries that are stuck in neutral. What early signs do we need to be paying attention to for you to believe that countries that are stuck in neutral are beginning to turn a corner?
So maybe to start off by explaining what stuck in neutral means, it means that these countries are having low investment levels, running current account deficits with low growth potential, and are vulnerable to external shocks. And for us to begin to see that they're turning a corner, these countries need to have clear visions with defined policies that are then are followed by good implementation. And we also, I think, to what Prof has been saying about how the others turned a corner, they need to leverage their natural resources and increase their investment levels. To then, when we see that increase, we're seeing the signal that they're beginning to turn a corner towards the other quadrants.
Okay, so we've spoken about the growth archetypes. Let's get to the currency archetypes, Sam. So how should investors be assessing the currency archetypes, and what are the risks and opportunities here when you take into consideration currency volatility?
Yeah, so I think Professor did mention the coil spring and the South African rand. So I think that's maybe a little bit easier to deal with than the mirage or the underdog, where there's overvaluation. But I think the way investors can look at it, and obviously it's a little bit part of our business as a bank as well, is looking at hedging and sort of your hedging strategies around the overvalued currencies. It comes to a point where, I mean, it's something we discuss a lot about Mozambique, where it's now at a level that's been it's been persistent at a currency level around the 64 level, slightly higher. But of course, you do feel that the fundamentals are now telling you that the currency needs to be weaker against the dollar. And, you know, when we look at it in those quadrants as well, you think, okay, these overvalued currencies at some point need to change, and when that point is. So I think from a business perspective or from an investor perspective, it's to just understand that. Obviously, we have very astute investors who do understand that, but then I think where we play a role is more on the hedging side of things and looking at hedging strategies.
Okay. Adrian, I want to come to you here because this year we introduced an export potential model. What gap are we trying to fill here in trying to understand the continent's trade trajectory?
It's looking at a couple of things that export potential. The first is the capability of the home country, and then the second, using global export markets. You know, where could we go to? And here, collectively, the continent punches way beneath its weight. There is massive opportunity here for the 31 countries as a combination to pursue one of Joe Studwell's ingredients, and that is to see the world as a market. What we've been at pains to do in highlighting this export potential is to separate out the United States, because that is that's the tricky market to make sense of, because I think it would be academic in this environment where you could wake up on a Monday morning and you get 100. Or maybe you get taken from 100 tariffs to 30 because it's a different Monday. But in the next breath, you've got China saying we're going to open this market for all of Africa with as a duty-free destination. And so the potential here is absolutely spectacular, but it only becomes realized potential if we start to install all of the ingredients that we've spoken about elsewhere in this conversation.
Okay. Precious, let me come to you as a sort of nice segue from what he spoke about around trade, with just less than a minute left here. And I'm going to pause my side of the questions. Let's talk about AfTA. Let's talk about PAPS. We've been talking about trade barriers for quite some time, trade potential across the continent, intercontinental trade. What are the main barriers here that we're still dealing with, and perhaps how do we accelerate AfTA and PAPS?
So the main barriers that we're still dealing with in terms of the implementation of AfTA is the well-known, infrastructure deficit. There's poor infrastructure in Africa in terms of road, rail, and ports, the non-tariff barriers, the fragmented financial systems, and political and regulatory uncertainty. And also, I think the key one is the limited industrial capacity. So some of the things that can be done to improve, obviously address the challenges, to accelerate this, will be to build more capacity in terms of the infrastructure gaps, harmonizing trade standards across countries, and as well as developing regional value chains and capacity so that we actually have our own continent-built goods to be able to trade with each other, and also looking into the payment system that we accelerate the use of PAPS so that it at least eliminates some of those challenges related to fragmented financial systems where we need to always have to find a third currency to be able to trade with each other.
Okay.
Can I hop onto this very quickly with I'm mindful of time. Anna Mamagobo, the chief economist at NAMSA, speaks about thinking, going back to the comment about export potential, there is abundant potential in the neighborhood, regional potential. And so, Precious's response on your previous question just, remind me of Anna's observation that there is an export potential for South African auto, for instance, 1 million vehicles into Africa.
Okay. I'll come back to that when we do have time and I'm done with all the audience questions, because you just brought up something that I do want to ask. So I'm going to open up the floor for audience questions. If you have any questions, do raise your hand and then we'll get a microphone going to you. And then online as well, I do see there is a question that has come through. But let me deal with the audience questions. Any questions? There's a question right at the back. We'll get a microphone to you.
Thank you so much for the insightful discussion. You haven't mentioned Egypt in detail, and it features at the top of the list and has been there for a while. Just want to understand what fundamentals keep it there, despite some of the political uncertainty and risk.
Who wants to take that one? Sam?
Yeah, I think Egypt, you can't ignore the sheer size of the economy, so that plays a big role, just looking at the first pillar in itself. Granted, we have seen some not as great growth maybe over the past year or so, but we've seen in recent quarters that's accelerating. And what also keeps it there is, when you look at it from yes, it does have a large current account deficit, but it has a lot of funding coming through. So the GCC is very supportive of the country. I think investors do know that the region won't allow it to fail. So that's part of it. I think the reforms have been very good as well. So yes, it may not rank great in FX volatility of late, but I think overall it's getting to a point where you can see stability just because of some of the reforms it needs to do. What the report doesn't say is obviously the reforms that it probably needs to do a little bit more of in terms of privatization and those type of things. But I think overall it's fairly stable, fairly supported by the region. So I think, it's probably going to stay up there for some time.
There is a question that's come online, and it says here, can you please comment on Kenya's outlook given debt sustainability concerns as well as upcoming elections? Who wants to talk about Kenya? Mm-hmm. Here we go.
I can try.
Sure.
Kenya, I think, is in a better place than what it was around this time last year. It has maneuvered the public finance liquidity concerns that were a key issue, I think, beginning 2024 when that bond was due. And we know by now that they managed to refinance that without much trouble. And they've since come to the market twice, and they've been well supported. So I think at this point we can safely say that the debt sustainability concerns are at bay, although if you look on with a long-term scale, there's still some challenges and some improvements that they ought to do there. And you've mentioned, the question mentions that there is an election coming up. So Kenya will be going to an election in 2027, and that is in this current environment being defined by the, I'm not sure what the right word is, untimely death of a key political figure, Raila Odinga, in Kenya. And with that, also they need to maneuver that against, they've requested for an IMF program, but we know implementing reforms out of the IMF could be politically challenging and limiting when you are also eyeing an election. So it's one of those things that we have to watch and see how they maneuver that over the next year.
Okay. Just checking if there are any, do you want to?
Yeah, I think I'll just add to that. So, I mean, in terms of liquidity, just because Kenya has been getting an array of financing, I think, the near term, it looks great. I think where Precious and I normally, chat on is on just the sort of medium term perspective where, yes, they're trying to do all these great revenue collections and they can't affect policy. So I think that it's a classic case of, the policy and that sort of change and being able to affect policy that could affect debt sustainability in the medium term.
Okay. Checking if there are any questions. There we go. There's a microphone coming to you.
A question to Adrian or any of the panelists who are brave enough to answer. It's Garth Tennyson from News 24 Business. I don't know if you're aware, but there's this movement afoot with South Africa hosting the G20 to kind of put it on the agenda that Africa's facing what is described or termed as unfair borrowing costs. And there was a Standard Bank had an event a while back, and that was the main topic of discussion. And I couldn't help thinking that, to my knowledge, borrowing costs are essentially set in the bond market. So is it realistic? And how effective would that be, taking that sort of position to the G20? I know it sounds good, it makes for very nice headlines, but is it actually realistic to lobby for lower borrowing costs at a political event when borrowing costs are essentially set in the bond market by thousands of bond traders making minute-by-minute decisions?
Who wants to take that one? Bravery was the word that was
I'm delighted Isaiah is here.
Let me perhaps give it a try. First, if you look at actual data, there is evidence that suggests that there is some sort of a premium to bond yields that is not justified by data. The point that was mentioned, Africa is the second fastest growing continent. That's growth. You have potentially the fastest growing economies, 10 of them right about there globally that are in Africa. That means from a growth perspective, we have seen significant growth, but it's not yet reflected in some of the market pricing that we see. Let's park that aside. There is a qualitative overlay in how credit ratings are constructed. It is in that qualitative overlay where most of the African countries' rating gets downgraded or downweighted. If you don't have enough data or information about a country, the easiest way is to put a premium on how you price this debt. So in part, it's a reflection of the lack of data or insufficiency of data compared to the advanced economies, which we believe a report like this tries to fill that gap by bringing that information to the investor community. But the point is very justified. It's not a chess in the, looking for something that doesn't exist. It actually exists. There is data to support it. So it is a genuine call that is being put at the G20 to say, hang on, guys, this qualitative overlay that always results in downweighting, never upweight, always downweighting. Can we look at that and try to reduce the cost of debt?
Could I also, Garth put it, my name in the question. So I think to pick up on that last observation that Isaiah makes, that shouldn't be lost on us, that when you don't know and you're taken into the world of suspecting or guessing, that's where the premiums start to come in. And here we must turn attention then again to ourselves. What are our statistical capabilities? What are we communicating? And there is a large gap here between, there is an agency gap, and we need to make it our business collectively, public and private, to start to communicate this. I could put it back to you. If you think of the authorship of content that comes from the continent, is materially thinner than authorship that comes from other places. And so you have to try and fill in the gaps. And there's, with data abundant and very, very rich pools, there's an opportunity here to shine new light using, in our reference before, alternative data for figuring out informal markets, et cetera, Why isn't this being added to the conversation to bring transparency?
Sure. Yeah, I wanted to add to that. I think there's also two elements. There's sort of your domestic bonds, where inflation in most countries are already sort of low teens, thereabout, and some of those interest rates are rightfully where they need to be. And Of course, in some countries you do get, because there's, what they call fast money coming through a lot. A lot of countries on the domestic market do keep these rates quite elevated just to get those flows coming through. So the likes of your Egypt and Nigeria. But I do agree, I think, with both Isaiah and Adrian on the sort of external side of things, because you do get a few things built into some of those yields, including things like political premium when you're going through an election cycle and things like that. And it's sometimes a little worse than in most regions, but arguably, there is some method to how investors look at this.
There are two questions that have come online, and I'm going to read both of them, and you guys can decide who wants to take which question. The first question says, as data becomes the new oil, how can African countries control and monetize their data without surrendering digital sovereignty? The second one says, what is the panel's thoughts on Namibia's nascent oil and gas industry in the context of stuck in neutral? Will your views change if and when Namibia gets a final investment decision in 2026? So who wants to take the Namibia question, and who wants to deal with data becoming the new oil?
I can do Namibia.
Namibia.
Adrian's the data person.
The panel can decide.
Okay, so let's deal with the Namibia questions from both ladies, and then we'll get Adrian's take on data.
Should I go?
Yeah, you can go and then
Okay. I think Namibia at this point, it is a low growth environment. We just saw the half-year budget. They've widened their fiscal deficit expectations. So there's a lot going on there, a lot of positive stuff, but there's also these fundamental data that points to low growth, high fiscal deficits, and even their current account doesn't look as great. So I think, there's that fundamental perspective. And then when you do get something like oil or an oil find, obviously first it needs to be commercially viable, which Namibia is still looking at getting that done, or some of the oil companies are. But then it comes to, how do they manage those flows? Because we've seen in the case of Mozambique, they've had a lot of boom and bust cycles. So you had the aluminium, you had the coal, and now obviously the LNG. And you don't want Namibia to fall into that. So I think the perspective might change, because there is a small forward-looking component to our model on the first category. So maybe in terms of your growth outlook, all of that will change. But I think just in terms of the policies and how that looks and how that shapes Namibia going forward, that's going to be quite integral to see whether they can sustain that growth and use some of the funds for investment going forward.
Okay, Adrian, the data question.
Just to add on the Namibia story, I like that Sam brought the contrast with Mozambique. I think Namibia it has a good stand in terms of actually monetizing their oil and gas finds that they've had, because they've got strong institutions, political stability, and that could move them from this current trajectory of being stuck in neutral and low growth environment to greater growth. In terms of the second bit, part of the question of whether we will change our views. So again, we use a predefined methodology, so it's not necessarily our views, but rather how if they get an FID next year, how that moves the macro data, the underlying macro data.
Okay.
Yeah. John Maynard Keynes says, when the facts change, I change my mind. When the facts change, the model, the framework will produce a changed opinion. And very briefly, a few words on Namibia, Dutch disease resource curse. And they are alive to those risks. And the task for Namibia is to mitigate those risks, and then the threat becomes a fantastic resource.
Okay.
The data. Yeah, so the irony shouldn't be lost on us that, all of this fascination with data through the looking glass really sits on the backbone of copper, cobalt, absent these critical resources, rare earths, and you don't have abundant data. So we've got the stuff that matters. And Paul Kagame says, Africa's been hollowed out a couple of times. Of course, the horrors of imperialism, colonization, multinationals, multilaterals, the big men, and yes, it was men, etc. And his pushback is, if we get hollowed out another time, I wonder whose fault it is. And so there is fantastic potential here for South Africa to monetize the data, to go to the question that's asked, because this allows you to sort of work from anywhere, be anywhere, do anything. But for that to happen, we have to have, I'll go back to, it's my sawhorse, we have to have the infrastructure that allows Africa to participate globally in data.
Okay. Any other questions from the floor? We're just over 2 minutes left. Okay, we've got a question from that gentleman there.
Good morning. Good morning. Thank you for the panel. You haven't touched on Ethiopia as well, singled it out. Can you maybe just give us some color on, especially given the currency devaluation that happened there, they're opening up the economy seemingly, just your thoughts on Ethiopia?
Yeah, I can touch on Ethiopia. I think there's a few challenges in Ethiopia. There's some that have been there for a long time, including the FX liquidity. And most people that look at it, focus on that, especially those that have investments there. And we know, the likes of China, Turkey, India, but also here in South Africa, there's a lot of investments in that economy. So I think in terms of the liquidity issues, obviously they're trying to resolve that with FX devaluation and looking at multilateral support, the likes of the IMF. They're also going through a restructuring of some of the external debt. Personally, I don't think they should have done that at that point, because I think it was manageable, but they have chosen to go down this road, which means, there is going to be, similar to what we've seen in the likes of Zambia and Ghana, some short-term pains. But I think the trajectory for Ethiopia as a whole is very positive. I mean, we've seen the growth rates, we've seen the electricity production, some not so great and then causing some conflict, but I think, from a manufacturing hub perspective, and we've been touting East Africa as a manufacturing hub for some time, or it's going to be there. I think the low labor costs, the low electricity costs make it ideal for Ethiopia in terms of the outlook. But at the moment, they have to go through a little bit of worry.
Well, we've come to the end of this particular panel discussion, and as I mentioned in my opening intro, about 31 key markets here. So if there's any particular country that you are interested in and we didn't get an opportunity to touch on, you are more than welcome to approach the panelists after this particular discussion to ask your specific questions. Thank you so much to the panelists for such a engaging and well-rounded discussion when it comes to the context that we're dealing with relating to the continent, covering the data, and if there's any specifics that you do have, you're more than welcome to approach them. So thank you so much to Precious, Adrian, as well as Samantha Singh Jami. And thank you also to those of you who have been asking questions in the audience. We do appreciate the time you've taken to be here with us. So until next time, thank you so much for being here. Goodbye.